What's the purpose of a Darwin Index, and how is it different from a trader's strategy and their signal account? How do the risk adjustments that are initiated by the Dawinex Risk Engine produce one of the fairest ways to measure true trader skill, while at the same time producing one of the most transparent ways for investors to seek out their next investment opportunity? I'll be answering all of these questions and more in this video. As you're probably already aware, when you're in the Dawinex Zero platform, there's a difference between the metrics on the Signal Account tab compared with the other 4 tabs shown here. The Signal Account tab represents the raw results directly from your trading strategy. The other 4 tabs, however, provide metrics from the Darwin Index, which is based on the trades from your Signal account, but after they've been risk adjusted. The first question to answer is, why is it beneficial to perform this risk adjustment? The best way to illustrate this is by using an example. Let's imagine 2 fictitious traders. We'll call them Trader A and Trader B. Trader A has a relatively low skill level when it comes to trading, and they don't manage risk particularly well on their account. Furthermore, they have a tendency to often over-leverage on some of their positions, putting their account at higher risk. Trader B, on the other hand, is quite the opposite. They are a highly skilled trader, they manage risk well, and very rarely use inappropriate over-leveraging. So let's look at a few examples of trades that each of them might make. Each position that we look at will have a size and an outcome. I don't have any units on either of these, but you can imagine the size could be in lots, for example, and the outcome could be euros or dollars. It doesn't really matter. What's important for the illustration are the relative values. So on this first position, Trader A, who is the unskilled trader, makes a loss. They also incur a loss on their second position. Now you'll note that they've reduced the position size here, not for any good risk management reason, but maybe because they've become nervous following the previous loss. Unfortunately, this and the next 2 positions also result in losses. At this point, Trader A is beginning to get frustrated. They decide to increase their position size considerably in the hope that they'll quickly recover the recent losses with this next position. In fact, the size of Trader A's positions is often dictated more by how they're feeling on a particular day than on any reasoning or logic. But fortunately for them, on this occasion, they have a large win relative to their recent losses. But the outcome is probably more down to luck than good judgment and skill, as we've already seen. Following this, a further losing trade occurs. Let's now contrast this with Trader B's positions during this same period of time. Here, you'll first notice that good trading and risk management skills have served them well, with only 1 loss, and that was very small. Next, you'll notice that their position sizing strategy has produced much more consistency, and any differences in the position size here are probably due to the trader equalizing risk across each position. We can view the recent performance of each trader on simplistic equity charts. We can gain better insights, however, by overlaying these. So, despite the difference in skill level between these 2 traders, over this period of time, Trader A actually outperforms Trader B in pure monetary terms. So if these 2 were both participating in Darwinia, based on this information alone, it would mean that Trader A would beat Trader B in the ranking. So we have to ask the question, is this a fair and valid way to compare and reward traders? Here at Darwinex, we don't think it is, and this is one of the reasons for the Darwin Index. Let me show you what happens behind the scenes when a Darwin Index is generated so that you can better understand. With Darwinex Zero, traders use a virtual account where they can execute their trading strategy. This is where the example trades we saw a moment ago would have been opened and closed. Each of these trading actions produces a signal, which is then analysed by the Dawinex Risk Engine. Now, it's important to note that the Risk Engine has been continually monitoring every trader's account, learning how they trade. It will therefore have already calculated what the VAR, or value at risk, is for each trader operating in their signal account. Basically, it has determined their risk appetite and the impact that their actions have in terms of risk. So it knows, for example, which traders are conservative in their approach to risk and consistently operating at a low VAR. It knows which traders operate at a much higher VAR. It knows which traders frequently over-leverage their account. So for every trade decision that's executed, the Risk Engine uses that information as the basis for the Darwin Index and will adjust the size to achieve a standardized risk level, effectively allowing all Darwins to be compared in a like-for-like way with similar risk. The specific value at risk that's targeted with this adjustment process lies in the range of 3.25 to 6.5%, with the exact value being dependent on the way that the historical VAR has changed in the signal account. But why? Well, this adjustment process allows for a much fairer comparison between strategies and is why it's the Darwin that is used to attract seed capital in Darwinia, not the signal account. It's also why the Darwin is used by third-party investors to more effectively compare different investment opportunities and help them make more informed decisions. All of this contributes to the Darwinex ecosystem being much fairer in terms of helping to identify true and consistent trading skill compared to short-term periods of good luck. There's also another important process undertaken by the Risk Engine that you need to be aware of. If it sees any unusual behaviour compared with what has happened historically in the signal account, then the risk manager may take action to reduce exposure. So for example, if a trader placed an unusually large position which was out of character for them, it might have even been a mistake that the trader had made, then the Risk Engine could take action to reduce that exposure in the Darwin. It won't close your position in the signal account, of course, but it might close it in the Darwin to protect investors in that Darwin Index and also protect the Darwin's track record if this was a mistake by the trader. So let's see what effect this adjustment process has on the performance of traders A and B in our example. We saw previously that the performance in the signal account was better for the unskilled trader than for the better trader. But as we know, this was because of luck or chance, not skill. If we look at trader A's signal account, we can see that they're operating at a VAR of 8.9%. And this will, of course, be based on their historical positions. Because trader A has a tendency to often over-leverage, this will be one of the reasons this value is high. Whereas for trader B, their value at risk is 2.5%. This means that when the Dawinex Risk Engine generates the Darwin Index for each of these, it will reduce the position sizing in trader A's Darwin to bring it down into the target range, but increase the position size for trader B's Darwin. So if we now view the results where each trader's Darwin has a like-for-like risk, we can see that the skilled trader is now shown to be more effective over this period of time. Many of you might feel unsure about this process that happens in the background and maybe consider it to be a black box that you don't have access to. But that isn't the case at all. And the Darwinex Zero platform provides you with all of the information, which actually makes it an extremely transparent process. Let me show you how in the Darwinex Zero platform. On the left-hand panel here, you'll see this Live Trades area. You get some high-level metrics displayed on the panel directly, but by clicking here, you get much more detail. The Darwin Risk panel shows the multiplying factor that is currently being used in the adjustment process to create this Darwin. In the section underneath, you can see this in action with the currently open positions. Here, you can see the size for each position in the signal account itself, so the trader will have made the decision over these values. And then on the right, you can see the adjusted values that have been used for the Darwin, based on the multiplying factor given above, 0.88 in this case. Because this value is less than 1, it means the risk is currently being adjusted down. If it was greater than 1, it would mean that risk was being adjusted up, all with the purpose of achieving that Darwin risk within the target range of 3.25 to 6.5%. But this value of 0.88 will not be static, of course. The risk engine is continually monitoring the signal account, and if the trader's behaviour changes and the signal account's value at risk changes, then this multiplication factor will be adjusted to keep the Darwin risk within the target range. In fact, you can view exactly how this has changed over time in the chart on the right, and look at it over different time frames using the selector above. You'll remember from earlier, I said that the risk manager is always on the lookout for unusual behaviour compared to what has happened historically in the signal account. In particular, it's looking out for any positions that are significantly over-leveraged beyond what has previously been seen, and for the reasons stated earlier, might close these in the Darwin to protect investors and also to reduce the likelihood of the Darwin's track record being damaged in the case that this was a mistake by the trader. If the risk manager does close any of the positions because of excessive leverage, the percentage closed is shown in the current closure rate panel here. To find out more detail about both of these risk adjustment processes, you can click here and here. So in summary, the Darwinex Risk Engine helps to ensure that traders get rewarded for their skills, good risk management, and consistency. Conversely, it reduces the likelihood of rewarding lucky decisions and over-leveraging. We firmly believe that this is what makes Darwinex the fairest ecosystem to help traders get seed and investor capital, and also provides full transparency for third-party investors to help them make informed investment decisions. But maybe even more importantly, the Darwinex ecosystem provides an environment for traders that's conducive to help them nurture and evolve their trading skills without ever feeling under pressure to over-leverage in order to attempt to outperform other traders. You can find a link to all Darwinex Zero videos in this video's description, and a link to our next recommended video is provided on screen now. Also, to make sure you get all the latest news and updates on Darwinex Zero, don't forget to follow us on our social media accounts shown on screen now.